Hi, this is Randy Finney with Right Side of the Chart, and this is a midday market update for Friday, May 24th, 2019. It's about 12, almost 12:30 Eastern Time as I'm starting this video. Just want to do an update for members on the broad markets and some of the trade ideas. We added a few new trade ideas today. We closed out quite a few yesterday and earlier this week. So obviously, those were the final targets on, for example, crude oil and QQQ and SOX earlier this week. So therefore, the odds for a bounce, in my opinion, are elevated. I think I've made that semi-clear going into yesterday, and I hope certainly clear today, this morning. Now, couple updates or things to consider. Today is OPEX. For those of you not familiar, OPEX is short for options expiration. There's all different expiration dates, but the standard options in index and equity futures expire the third Friday of every month. That is today. What does that mean? Well, during OPEX days, it's quite common to see a lot of back and forth price swings as options traders square off their positioning before they expire after the close today. So just kind of keep that in mind. So we have not only OPEX, but when you have OPEX coupled with a period of increased volatility, such as we've seen in the last few weeks, that increases the odds. You're going to see some back and forth, pretty sharp swings. So wanted to point that out. And also, I'm back at my desk now. I'll catch up. I've tried to catch up on most of the trading room replies, any comments, any emails. I'll get to that as soon as possible. Sorry I had to run out. We're taking the family to Costa Rica soon. Didn't realize their kids have to have passports, and they require that both parents have to go down to the passport office. So we had to, my wife and I had to do that this morning. But I'm back in my desk now, and wanted to get this video out to you guys as quick as possible. Bigger picture, look, as I said in the update this morning, by the way, if you're not getting emails on the updates, if you're a member of the site, that's automatic when you sign up for the site unless you've opted out. The majority of the emails that I get from the support site or on the site somewhere, people not getting those, it's usually in your junk folder somewhere else. But of course, if you're not getting the emails every time a new post is published, check your junk and spam folder. If you can whitelist the domain at Right Side of the Chart, that will certainly help. You can do a quick Google search to see how to whitelist. That means to allow all emails coming through there. And if not, just drop me a line and I'll look into it for you. All right. So to just sum it up in a couple sentences. Here we are. We're at the key 178 support level, which was briefly undercut yesterday, but then regained, and we kept it on a closing basis. So that's so far two successful defenses at that level. Remember, what happens intraday, not only was that not bearish because we undercut it and then closed back above, and the daily close is all that matters, but the fact we did undercut it intraday to me is bullish. Because what that does is it does two things. It clears out stops on weak-handed longs. I don't mean that term offensively. It's just another term I use in the market. Weak-handed longs mean you have two types. You have buyers that will buy Apple, QQQ, and they'll hold on to it no matter what, come hell or high water, because they love Apple or whatever the thing is. Then you have the weak-handed longs and shorts that are nervous pullbacks, and when you flush them out of the market, at least on a temporary basis, it makes for a more long-lasting rally. Why? Because it changes a supply dynamic shift. That you have the longs that are in place are going to hold on. If they didn't wash out here, they're not going to wash out on a little pullback along the way. So it's good to have again, the term weak-handed longs washed out. And so two things happen when you break a well-watched support level. You have shorts pile in, who then, when they see that they took a breakdown on 178, but the breakdown failed, if and as we continue to push up, they start to get squeezed out. They're underwater, they're losing money, and they're all going to have their stops at different places. Some might have had a tight stop right back above 178, but the higher we go, the more pain they feel. And then, as I always talk about, shorts must cover, and at some point. And so therefore, you could have a potential short squeeze here, or it could just add fuel to a rally. And again, it also, you have a better hand of long buyers in there. Now, that's the bullish case, and so far we are on day 3, the third day. Remember, back here yesterday and today, a successful defense of 178. A, the day is not over. B, we're in extremely close proximity to that level. There's a lot of damage on the longer term charts, the daily and weekly, and I have still a pretty high degree of confidence we are going down lower. But somebody asked me today in the trading room, Randy, if your Apple targets are hit, doesn't that conflict with the downside scenario? Not at all. Nothing goes straight down forever. So let's just say, this was a kickback rally. This could be another kickback rally here, and then we go back down. So this is my current scenario, very near term. I am bullish right now, cautiously bullish, but bullish and long, and ready to flip that around, close those longs out, maybe even go back into shorts if something happens. It's going to get a little scary here because we have a 3-day weekend, so that's a consideration to make if you're swing trading. If you have positions now, long or short, or if you take any positions today, you're taking them with an extra night of overnight risk. Swing traders have 2 days of overnight risk on a weekend. 3-day weekend with Memorial Day coming up, you now have 3 days. What does that mean? Well, it's an extra day for a negative headline to come out that could turn around, or a positive headline in that, for that matter, that could lead to a large gap on Tuesday in either direction. So how do you manage that? Well, there's an old adage on Wall Street: sell down to the point at which you can sleep at night, and likewise, don't take home more than you're willing to lose if the markets, let's use an extreme, and again, I'm just talking the market. Individual stocks can certainly go up or down more, but let's just say it's not an absolute extreme, but about a 3% gap in either direction. That's about the high end of what I've seen, and it's again, the high end. So just kind of look at that, and if it helps, use a trade position size calculator. There's a link on the top menu. Enter your number of shares, price per share, whatever. It'll quantify for you in dollar terms what would that mean if if we gap down 3% or we gap up 3%. So that's food for thought. And again, today, OPEX volatility. Let's just watch how things close end of day, unless there's anything big that happens, such as, let's say we dumped hard today and we undercut yesterday's lows. Certainly possible. I don't see it, but possible. And if it does, that's just not a good sign. So let's look at SPY before we move on. Daily chart, SPY. Remember, SPY even never even touched that previous low. It made a higher low so far, and it's moving higher today. Not a lot, but that's what we're looking at right now. 60-minute charts. SPY didn't have a divergent low on the 60-minute. It may have on the futures. I'll have to get to ES in a second, but that's because it never made a lower low. Now, my focus has been tech. And this rally, the rally off the lows off December 24th last year, that was all about tech and the FANG stocks. So therefore, to me, this correction is all about, or mostly about, tech and the FANG stocks. I don't want to get off topic here, but there are some developments I'm watching, and I'll show you this real quick. That tells me, look, the economy the market is finally starting to price in what I've been saying for a long time. A lot of people didn't think it's coming. There's probably going to be a recession starting here in 2019. Why? What makes me say that? Well, look what's going up. These are the defensive sectors in the S&P 500. XLU going to new highs. By the way, that looks to be a setting up for a nice short. I think we'll get a pullback trade to at least the breakout level. Yes, they're defensive stocks. Yes, that's what you want to own going into recession. But guess what? Cat's out of the bag on that one. The utilities have already rallied quite a bit. This is the stock market. Smart money, institutions pricing in the probability of recession. They're moving away from high growth tech stocks, things like that have carried the market all the way up to where it is from the 2009 lows. We're seeing semis roll over tech, and we're seeing money flock into safety. Utilities are defensive stocks because no matter how bad things get, you do not stop paying your electric bill, your water bill. So their earnings are consistent throughout the business cycle. But I will say this, they drop. Don't get me wrong, you go back to 2009, they will fall during a recession. They just tend to fall less. And just this is what we watch. Economists watch, stock market analysts watch, shifts into defensive sectors to foreshadow or warn of a likely turn down in the economy, not just in the stock market, but the economy. And of course, that goes hand in hand. So there it is. Utilities punching out to an all-time or new high, maybe an all-time high there. Looks like a nice possible doji reversal stick there. And again, SDP, by the way, if you want to short trade, utilities are steady Eddie. You're not going to have a 8% down day in a utility ETF XLU. So this one I might add on as an official trade idea. It just has 2-time leverage on it, so double the juice here. But again, that's fine. I can even take in utilities normally you can take an oversized position because of the lower volatility compared to sectors like tech and all that. There's a divergent low, and I'll just show you right now. I'll have to fine tune the chart and give you some targets. Let me just get back here and not go off topic. But that's not the only one. REITs also defensive can be. Depends which sector in the REITs. There's all different type of REITs, but that's another sector that's looking a little toppy. Not ready to pull the trigger on it yet. I mentioned it here before. We had a quick pullback from right here, but there's one I'm watching as well. XLP consumer staples, another defensive issue. What are consumer staples? Things that you need, staples, toothpaste, deodorant, paper towels, things like that. And they also tend to do well, of course, because of their nature. They're almost the opposite of this sector is almost the opposite of XLY, consumer discretionary. So the way I like to describe it, XLP staples are things that you need, and discretionary are things that you want. So big screen TVs, Amazon, things like that in here. Of course, a lot of these companies actually do both. You got to be a little careful with that. The companies that belong within this ETF, like Walmart, I think, and things like that. All right, but I wanted to mention it had a nice run up, but already corrected. This is consumer discretionary. So this is telling a story right now. What's going on in the economy? Things that you want. Rolex watches, things like that, jewelry, that's discretionary. You buy that with discretionary income. Boom, that broke down. Now, here's the thing. Nothing goes down forever. So just like my view in the stock market, coming up to really nice support here at 112.19. So, my scenario looks something like this. It meshes with the stock market, maybe a bounce before the next leg down. Let's get back to the stock market. So here's QQQ. Here's that falling wedge, divergence. I'd like to see this PPO crossover. Sometimes you have a confirmed divergence. That wasn't confirmed. We didn't have a lower. This is the first positive divergence. It'll be confirmed if we can print a solid green close. These lines are just trying to cross now. That's also not a buy signal. It just confirms the divergence. A buy signal is going to come on a big green candlestick reversal pattern on the daily chart, or a breakout above resistance, something else. We don't really have a buy signal, but as I always say, there's two ways to go along objectively, either on a pullback to support, which is what we're doing here, or what I'm doing here, or a breakout above resistance. So, a next major buy signal would be if this wedge develops. And look, we can come down, maybe we come down, undercut those lows again to run a little more stops, break out. Maybe we just melt down. Again, this is why I like it here, and I really like buying its support, because your downside risk is minimal, compared to the upside reward potential. So this wedge could develop a little more, or it could go on and break out soon. These are just the targets from the previous long trade. These are not targets for QQQ right now. But you can look at these in reverse, these same resistance levels where the lines are at, and those are certainly potential targets. I also want to say this right now. There's a potential, this wedge, should it play out to its measured target, that has the potential to take the markets to new highs. It's not my preferred scenario, but simple measurement of a wedge, you take the widest part of the wedge, which I've done here with this trend line, add that to where the wedge breaks out. Let's say it breaks out next week, somewhere here. Well, that would actually fall shy of the highs there. So I just wanted to make mention that the measured target would take us close to the highs. And look, the primary trend, despite what's happened recently, the longest term trend indicators are still bullish right now. So the possibility of new highs and beyond is there. That's not my preferred scenario, but I just wanted to point that out. And if you are a believer that the economy has a lot more room to run, and the stock market does, then as I've been saying for weeks, I said it back here. This is where if I was bullish and long for new highs, I'd be buying with both fists at 178. So that was, the first chance. You had a second chance here, and you do that with a stop somewhat below. Again, it depends on how far your price target is. That's subjective. So my point is, you may want to, if you're not sure, you're kind of on the fence whether, if we do start rallying, whether we're going to go take out the highs and keep going or fail shy, well, you can just trail your stops up along the way and let your position ride. That's the easy thing to do. All right, so a little bit of work to be done. Let's look at the futures real quick. There it is, NQ, NASDAQ 100 E-minis. I mentioned this morning before I ran out. This would be my minimum bounce target right now. If the markets can hold this support level here, we have that level there about 74.60 and the downtrend line coming in. So that would be a minimum target. And again, if we break out above there, that opens the door for more upside. And I have to tell you, I'm leaning that way right now. So we'll see. Charts are dynamic, and so is my analysis. You can see these divergences have plenty of room to continue to build, even if we took another thrust down. So it's not the end of the world. Not ideal. I really don't want to see yesterday's lows taken out, but there's plenty of room in the charts for that to happen. Another thrust down, wash out a few more. Maybe the SPY wants to put in that new low to put in divergence. That's certainly a possibility, and then reverse. So I'm kind of giving things a little room here. If you're, again, risk adverse or not sure what to do, either keep things very light or just wait until the charts firm up. And hey, look, if you're still short looking for more downside, and I do believe there is more downside to come, if you're willing to give it some room, you could stay short here, and well, you just have to determine where your stops are based on your entry price and your downside target. There's an infinite number of potential cost basis here for short trade, depending on where you shorted, how much you shorted. And again, when looking at a trade, you want to assess your downside loss potential if stopped out versus your gain potential if your price target's hit. So you take your average cost basis on the trade, look at your price target, and then I like to use a 3-to-1 or better risk-reward ratio, meaning I'll risk $1 of loss for every $3 of gain or better that I'm shooting for. ES, S&P 500 E-mini futures, here we go. I think there's more bang for your buck as usual in QQQ if we get the bounce scenario. And targets, same, looking at that downtrend line, that top of that broadening wedge pattern. And again, a breakout of that, and this would be, let's just say right now, keep it very simple. This is my near-term preferred swing target for ES. They're about 28.92. So if you're kind of wondering how much that is, I have to grab just below where today's lows. So if I grab that, try to grab where we're at now, it'll move that other trend line. But that would be, what is that, about a 2.5% rally. Potential to go up that far, that would be about 3.3. But let's just say right now I'm looking at, in the S&P, about a 2.5% bounce there. And again, we don't have much of a buy signal, but now you'd be buying at or near support. And that would be your next buy signal on a break of that downtrend line there. In the trades I added today, the charts speak for themselves. Apple, as I mentioned, sometimes I'll take a trade in anticipation of a breakout that hasn't even yet occurred. So obviously this trade hinges very largely, almost exclusively on the bounce in QQQ materializing. If it doesn't, then this trade doesn't pan out. And remember, if you are trading both QQQ or NQ or any related ETFs or anything on to the Qs, you have an extreme amount of overlap with Apple and Intel because they're both top components. They're either going to play out together or fail together. It is possible once in a while one will go against the trend. Apple's yet to break out. There's my targets. You can, and obviously I should say this, use a more aggressive stop if you're only looking for a small bounce. If you are long and you're not going for this, I usually place a suggested stop based on the final target. So if you're going for a shallower target or your own targets, use a higher stop based on your targets there. Intel, INTC, Again, hit support on the daily, bounce there. That was my first resistance. It was too early to list a target, unless you took it the other day. Pretty big level. So I want to see Intel pop this level, but as I say, resistance is resistance unless taken out. And that's a pretty good big level. Support, support, support. It broke, tested again, testing it right now. 44.75. If it can pop that, I'll go on, hit the first target, and maybe the second or even third target by next week. That would be nice. But again, in a very precarious situation. We bounced off support, put in a bullish engulfing candle, but we're not out of the woods yet. And again, if the market has another leg down, if it can't hold 178 on QQQ, there's going to be a lot of forced selling, and Intel could get dragged down with it to the bottom of the support zone. That's why I set the stop a little bit below there. So there's the support zone runs from 43 down to about 41.64. It's defined by this big gap back here, plus we had a reaction, a gap backfill right there. There's more reactions on the top of that level, and that's why I prefer a reversal off 43, but sometimes we do that. And look, if this market is on the verge of a waterfall sell-off, and I have to say that, it is a possibility. We've had a very lopsided, one-sided trade on the way up, an extreme rally, extreme overbought conditions, extreme bullish sentiment off the December lows. And so when you have those one-sided trades, with that come very sharp corrections. And if we can't hold this support, we're probably going to trigger a cascade of stop loss orders and margin call selling. So I guess the point, and I said it earlier today, don't become married to these trades. I'm taking them because I think the risk reward is compelling, but you gotta be careful here, and don't get married to any one scenario, bullish or bearish, because anything can still happen at this point. We're not out of the woods yet. We don't have enough bullish evidence to firm up. Just one bullish candlestick on one stock doesn't mean that the whole market's reversed yet or put in a bottom. USO crude oil, not much to add. We hit the final target yesterday. 1206 is very good support here on USO. We also have support on crude. I'll get to that in a second. Crude futures, I think we get a bounce trade. I think we'll probably a good shot. We can come in and back test that resistance. Remember, this is support here. We gapped down below it yesterday, and now that's a logical resistance level. Be a backfill the gap. Futures are a little more important. They trade around the clock, but so we'll look at those here in a second. But I just wanted to say there's a potential trade there. And for whatever reason, crude can't. If it takes another leg down, I don't see decent support all the way down here on USO to about 1154. So keep that in mind. So, stop below yesterday's lows or even today's lows at this point. I wouldn't even let it get to yesterday's lows on USO. I would wait now at this point, since we've already reversed. A stop under today's lows, I think, is a better bet. There's a 60-minute chart. There's support right there, 1204. You can see how well defined that support is back here. And that's what we overshot it on, what I call a momentum-fueled overshoot. Came down with a lot of velocity, shot down, and so far we're holding that $12 support. PPO is starting to turn up. RSI is coming up off overbought readings, oversold levels. So the very least, let's say 1238, the bottom of yesterday's gap right there. That would be a minimum target, and max bounce target right now 1257. What does that give you in percentage terms? If you stepped in right here where we're at, give you about 2.3% to the first target, about 4 to the other target. DWT leverages it up 3 times. CL leverages it up many more times than that. But again, leverage, you have to account that, adjust your position size accordingly. Leverage cuts both ways. Both it can juice up your returns, and it also juices up your losses if wrong. Wheat still looking good. The active trade, we hit our first target. Remember, I have these lines set below the target set below the actual resistance level. Pulled back, as I said, T1, the former support level there was at 528. It's likely to act as support. We hit a low of 528. What was that? Wednesday. We hit a low of 529 yesterday. Successful defensive support. This is TA 101. It doesn't get much better than that. There's 2 opportunities on a pullback to recycle back in if you took profits there, or if you didn't take the trade when we originally added it, but you like wheat. There's two objective levels on a pullback to support after a pretty strong run up. Help to work off those near-term overbought conditions, and then a break above the recent highs should should do the trick. We may need to consolidate a little more, but I'm liking the commodities here, and I really think, if nothing else, and I always say this, I'm a big proponent of asset allocation, diversification. You have a portfolio that fires on all cylinders. One day you might get hurt on your index longs or shorts, or maybe you're trading oil, but then your wheat or your corn or something, or treasury bonds, different asset classes that are not correlated with each other. And that's, it's the same premise you use with investing, and you use it with swing trading as well, and it helps to smooth out the bumps in your portfolio. So there's wheat. Still looking good, but of course we need to take out the previous highs, and I'd like to see us take out that high right there. But we'll get to the wheat futures here in a second and look at those charts. But that remains in the first target. Joe popped the entry over 33 and drifted back a little. This is the coffee ETF. Keep in mind, somebody mentioned JOFF. I used to trade this. JOFF is the JJOFF is from the same company, but this is the old one. They retired this one. It says iPath. Barclays owns iPath. Volume is almost non-existent in this one. It's still tracking, but they don't I don't know how to say this, that they don't support it, but I believe it trades on over-the-counter market now. They retired a lot of their ETNs, their commodity ETNs, a while back, and so volumes have been diminishing. You can see it here. Look at the volumes back here and see it tapering off. And at some point, these may become a liquid. So JO is the current one, and that's the one that we went with for the official trade here. There's the targets. Not much more to add to that, other than let's look at futures here for a second. These are coffee futures. Let me give you a different one. KC. See, I was hoping to get, it's hard because you have to try to align these trades. The ETNs track the futures. That's what they're investing in. Futures are my preferred trading proxy because they're pure. That's what the commodity is trading. This is what's tracking the commodity. ETNs will attempt to track it, but they have fees and expenses, and they're trying to roll. But you can see here, wedge, breakout, back test, but I have resistance about 95.28. And this morning when I added that JO trade, I was figuring we get a pop above there, it would correlate with a pop above 33, but although we just stopped shy so far, I just want to say I'm still confident in the trade. I still like it. I think 33 will get taken out. I think the trade will go on, but right now support is support until unless, or resistance is resistance until unless broken. So if you're trading the futures, you might want to wait for 95 and a quarter or so to be taken out. Let's say 96, and then that should open the door. I already drew out the divergences and everything there. It's not here on this chart. These are the charts that I shared on the official trade idea. Traded coffee and ag commodities for years, and let me tell you, sometimes when they want to run, they can run, and overbought can become a lot more overbought. You can see the RSI, and you can see, when you look at this weekly chart, this is 20 years. It's just a wash, rinse, repeat thing. I look for these downtrend lines here. I'd like to see if I can get divergent lows. We had divergence on the RSI. Boom, breakout and a trend reversal. And these are major trends. These are big moves. This is log scaling. See how the prices compress here and start compressing up? If I put it in linear scaling, it would be these gains will look even much larger. But by using log scaling, it puts things in percentage terms. Because when coffee's down at 50 cents per whatever unit they measured in, a 50-cent move is a 100% return. But when it's at $3, a 50-cent move is not. That's what log scaling will do, and that's what you need to use on any security with a large range in price. Log scaling, it's going to tell a much more accurate picture of the technicals and trend lines and everything else. So these are the big trends, and there's another trend. You can see the trend line breaks. You can see the divergences, the wedges, the divergent highs, wash, rinse, repeat stuff. And so what do we have now? Weekly needs a little work to be done. Here you can see this most recent trend line. There's not a solid definitive break above that yet, but we do have the bullish divergence. Divergence has been building here on the PPO, and these were my targets from months back, and we still don't have a buy signal yet on the weekly, but the daily's starting to look very constructive. And I'm looking at these numbers actually have to be changed because we fell further. That should be now more than a 60% or 90% run up. So what I'm looking for is a major trend change here, not just a swing trade in coffee, a trend change where we can get returns like these, that 110% rally right here, and some big moves. So. Okay, we zoom down to this is a daily chart now of coffee, coffee futures. It's end of day, by the way. When I look at these are from stockcharts.com. They only show end of day prices. When I go into my other futures charts, they're live, the ones that we looked at earlier. But so we had a breakout a couple days ago, and the breakout so far remains above. And this is just real nice, clean, bullish divergence right here. Last time we had a divergent low was right there. Look at that big sharp. That was a big rally. Coffee went from about 95 cents all the way up to $1.25. What is that, 30% run? You can see a divergent low back here, another nice comparable rally. So that's where we're at. I just want to say I like coffee. Okay, quick update on gold. I still like gold, and I said this in the trading room or under the comments section of one post today. Look, and there's a lot of big ifs right now, but if the market does mount a decent rally over the next week plus, gold could face a headwind. It tends to catch a flight to safety bid, meaning when the market's under selling pressure, money comes into gold, like recently. But I'll say this, there are times where gold and stocks can rally. Again, asset allocation diversification, I like it. We're getting close to it being an official trade, not there yet. I've mentioned I want to see the euro and US dollar break out. What I'm showing you here is, this is a 60-minute chart of gold futures. Here's a downtrend line and a target here. Next target here, we've already hit. I posted this recently back here. We had a divergent low. Each of these targets have been hit, near-term targets. Next one here is at 1291-ish, and then the downtrend line comes in. So that's potential upside for targets for gold. Again, if the market rallies hard, gold could come under some selling pressure, but it is possible you could see both rally. Charts are pretty constructive right now. And then ultimately, like a breakout of this would be pretty powerful, this downtrend line. That downtrend line comes from back here and looks like, is that March or April? February or March? February, I think, late February. And of course, I'm waiting for this. Where is it? Euro US dollar pair, which will signal a trend reversal in the dollar, waiting for a breakout above this downtrend line, bullish falling wedge, and that 113-ish level right there in the euro US dollar. That would be a pretty powerful buy signal for gold. That would mean a trend reversal in the dollar most likely. So this is why I'm just a little cautious right now. I like it. And recently, the reason I posted it the other day, I had this 60-minute bullish falling wedge on the euro US dollar. You can see, and we broke out and ran up impulsively, took out resistance. So the 60-minute chart's firming up. The daily chart still looks like a breakout is coming soon. So again, I'll keep it as an unofficial trade, maybe partial position now, half position, and if I make it an official trade, I'll certainly increase my stake in gold. Okay, I'll hit on Bitcoin just because there's some interest in the trading room, and I've shared this chart recently. Here's a trend line I'm watching. You recall we had back here, had a scenario that would come down, come and backfill the gap, which we did. So I'm referring to this gap right here. We already had a backfill of that gap, and it came in perfectly with the uptrend line. And then, so I said my preferred scenario, and this is why I'm updating it now, would still be to see something like this. See a little more upside on Bitcoin. These are Bitcoin futures, by the way, GXBT. It's my preferred trading proxy for Bitcoin. Push up, make a marginal new high, and it could come with an equal high. This line yet to be seen, but then I'll be looking for some type of reversal, and that will give us negative divergence, some nice divergences, and I think set up a pretty nice swing short for Bitcoin if you don't trade futures. And these contracts are only they're pretty low price. I think it's like, if I remember right, 16,000, or no, maybe it's dollar for dollar. Maybe there's a leverage factor of just one, so about $8,000. Problem is when you short it, the interactive brokers, at least, man, it was like a burn up like 40,000, 50,000 of buying power per contract. They have a extreme margin requirements on shorts, but not on the longs. So again, for longs, you're talking about an $8,000 exposure, but on shorts, same dollar amount exposure, but keep in mind, just want to check with your broker and see what their margin requirements are. And another option too is GBTC. Let me grab that for you. There's one of the, it's similar to an ETF. It's like a closed-end fund that tracks Bitcoin. So there's another option for potential shorting procs on GBTC, shorting procs. All right, long video, but I always, every time I do an update on gold or people ask about GDX, remember GDX are equities, so they can get dragged down in selling pressure in the broad market. But technically, if gold continues to firm up, GDX, I pointed out earlier this week this triangle pattern here, and GDX has fallen to the bottom of that triangle pattern, so could go either way. And if there's another leg down the market, gold may outperform. Normally the miners outperform both to the upside or downside. However, when you get strong sell-offs in the equity market, because GDX and gold mining stocks are equities, not a commodity or a precious metal like gold, they can get dragged down in the selling, and gold can actually outperform. So, but if everything does well, gold does well, and the market holds up. And sometimes during market corrections, don't get me wrong, GDX can certainly rally. So that's something I've been watching. And I have quite a few individual gold mining stocks that keep popping up. I have a watch list that's growing so large. I've got dozens and dozens of names. I'll have to call through those. And quite a few of those are gold mining stocks, gold or silver mining stocks. And then finally, we'll wrap this up here. Get a lot of inquiries on silver. Silver continues to work its way down within this bullish falling wedge I've been highlighting. Little divergences are almost, well, pretty much almost being taken out. We have about equal lows, barely holding on to the divergences on the PPO. It's not a must, but most importantly would be a break of the downtrend line there. And silver took out that $14 support level. That I'm not so hot on. Would have preferred to see that level hold. A key support down here around 13. Remember, silver is, although it is also considered both an industrial and precious metal like gold, it has more of industrial use than gold. Gold is still the king of flight to safety as far as the precious metals go. So market volatility, gold tends to catch more of a bid from the flight to safety thing, and than does silver. But with that being said, this is a nice wedge, and if silver can break out, you can see all these are potential targets, these lines, and I think it would come here to this downtrend line right there. All right, let's wrap it up here. And we'll see what the markets do, see how we close today. Just remember, OPEC's going to be some volatility before the close, and I'll do an update at the end of the day. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.